A lot of young working professionals at MNCs and startups have found a new way to create wealth. This is through participating in their employer's stock. There are many ways in which they're able to do this. Some of them participate in employee stock purchase programs where they buy the company stock over a period of 6 months or 12 months. Some of them are entitled to compensation through the form of ESOPs or RSUs. Now, this is a great way to create wealth, especially if you're an early believer in a company's growth prospects. But it does come with some level of concentration risk because your career growth, your compensation, as well as your investing and saving style is all linked to the same company's performance. This is something that we wanted to address in our next webinar, where we're looking beyond ESOPs and rewriting your retirement story. Do join us for some strategies that can help you save wealth in an optimal and effective way to create a successful retirement portfolio.
Finding value. In a market like this, when value investors meet up or chat up on WhatsApp, the general conversation tends to be a bit exasperating. Are you finding any value anywhere? Is some part of the market looking interesting? Are you able to find some new buys? We all seem to be throwing anxiety at each other. But the answer to finding value is not throwing anxiety at each other. It's actually putting our anxiety aside and taking a dispassionate view of where the market is pessimistic. If we are able to find out where the market is pessimistic, we will be able to find value. Often we will be able to find value in the most unexpected places. In the last decade, twice I was able to find value in IT. Usually IT is supposed to be a growth business and rarely will IT stocks look like value stocks. But twice in the last decade, one was able to see IT stock trading like value stocks. A more unlikely candidate to present itself before us as a value stock is the FMCG industry. But post the global financial crisis between 2009 and 11, FMCG stocks traded like value stocks. In the last 15 years, twice pharma stocks have been trading like value stocks. One was during the US FDA crackdown post 2015. A lot of stocks lost significant value and investors were very risk averse to buying them. And that was a time when the valuation started trending gradually down and reaching a zone where they started looking like they were value stocks. Again, after the global financial crisis, pharma stocks traded like value stocks. But the most unlikely candidate to be trading like a value stock is the private bank space. I mean, if you have tracked HDFC from the date of IPO, HDFC Bank never traded anywhere near the value zone except for a brief period after 2008-9 GFC. Worse still, Kotak Bank suddenly looks like it's in the value zone. If somebody had told me in the last 5 years that Kotak Bank would come to this valuation, I would have wondered what would be the trigger that it would come to this place. Because everything was hunky-dory. There was nothing that could go wrong. The same could be said of HDFC Bank as well. These were marquee banks with very good operating management, boards that were reasonably strong, and trading always north of 3 times price to book. But these banks today seem to be gradually gravitating towards the value zone. So, you can't predict what kind of stocks will come into value zones, but at different points in time, you will find great businesses in the value zone. There's nothing wrong or odd about that at all, because that space or that phase is not forever. It's for a brief period of time, and once that phase gets bought into by value seekers, and the company starts getting traction in the minds of investors, it would gradually move out of that zone back into the growth zone or back towards the growth zone. So, it won't stay in the value zone for too long. I am sure that there are many companies which have had a dream run between 20 and 23, which are now trending towards the value zone. There are many industries where we had over optimism in 22 and rising pessimism in 24. So, whenever pessimism is rising and where we find that the pessimism is overdone, you will find value because others will not be willing to even look at it. The secret to finding value in times like this is to look where others are not willing to look at. And the market would shun those companies. I won't be surprised if the buy at any price stocks also trend towards the value zone. It can happen. It has happened before, it will happen again. And when they come towards that zone, at least a few of them will be purchasable or buyable as value stocks. And when growth returns, the upside will be entirely ours. That's essentially the opportunity that I see in the market today. The opportunity to identify businesses which are trending towards the value zone, and the opportunity to keep close track of when these businesses enter the value zone, and the opportunity to buy them when that short window opens for us and these stocks are in the thick of the value zone. We may get 2 or 3 or 4 stocks in a year, but that's more than enough for you to build a great portfolio. It's more than enough for you to bring freshness into your existing portfolio. It's more than enough for you to seed future growth in your current portfolio. So, finding value is not easy, but it is not impossible. Thank you for watching this video.